Macroeconomics for Investors. Chapter 7, Business Cycles. Section 1, Expansion. An expansion is the part of the business cycle when the economy is growing after it has already hit bottom. It begins at the trough, when recession conditions stop getting worse, and it continues until the economy reaches a peak. During this phase, the improvement is broad, not limited to one statistic or one industry. Businesses produce more people find work, incomes begin to rise, and households usually gain confidence. What matters is that the growth is sustained over time rather than just a short rebound after a sharp drop. For investors, expansion is the environment in which risk appetite often improves, but it still needs to be judged by how broad and durable the growth really is. Economists usually do not label an expansion because of one strong quarter or one encouraging headline. They look for several indicators improving together over a period of time. Real GDP should be rising, but so should employment, household income, consumer spending, and business investment. That breadth matters because a healthy expansion spreads through households, firms, and industries rather than staying concentrated in one corner of the economy. A temporary bounce in output can happen without a true cycle turn, especially after a shock. The stronger the overlap across these signals, the more confidence we can have that the economy is in a genuine expansion. Expansions often become self-reinforcing because one improvement helps create the next one. As households feel more secure about jobs and income, they spend more on goods and services. Businesses respond to that stronger demand by increasing output, rebuilding inventories, and expanding capacity. To support that activity, farms hire more workers or increase hours, which raises household income further. That additional income then feeds back into spending again. This is why expansions can gather momentum once they begin. One person's spending becomes another person's income, and that income supports more demand across the economy. Spending often picks up early in an expansion because many purchases were delayed during the recession. People may have postponed buying a home, replacing a car, or upgrading appliances and furniture until they felt more secure. When confidence starts to return, those interest-sensitive categories can rebound first. Lower borrowing costs can reinforce that process by making mortgages, auto loans, and business financing more affordable. Durable goods are especially important here because they are easier to delay in bad times and easier to restart in better times. That is why housing, autos, and other big-ticket purchases often help lead the economy out of a downturn. Policy often plays an important role in the early part of an expansion. After a recession, central banks may keep interest rates low to encourage borrowing, support spending, and reduce debt service pressure for households and firms. Lower rates can help housing recover, make refinancing easier, and improve the economics of business investment. But policy does not stay supportive forever. As the expansion matures and inflation pressures begin to build, central banks may gradually raise rates or become less accommodative. For investors, that means the same policy backdrop that helps launch an expansion can become a headwind later in the cycle. Some inflation is normal in a healthy expansion. As demand rises and labor markets tighten, businesses often gain more room to raise prices, and workers may push for higher wages. Moderate inflation by itself is not automatically a warning sign that the cycle is ending. In many cases, it simply reflects an economy that is healing and using more of its productive capacity. The bigger risk is not inflation in general, but inflation that starts accelerating quickly. When price growth becomes too rapid, it can squeeze consumers, hurt margins, and push central banks to tighten policy more aggressively. Not all expansions are equally strong, and that matters a great deal for investors. Some are fast, broad, and durable, with solid GDP growth, healthy job creation, and wage gains that spread across many industries. Others are slower and more fragile, with growth concentrated in a small number of sectors or regions. You might see output improving while hiring remains uneven, or consumer spending holding up while business investment stays weak. A narrow expansion can still support markets for a time, but it usually carries more risk if leadership fades. So when analyzing an expansion, it helps to ask not just whether growth exists, but how deep, broad, and sustainable it appears to be. Sector leadership often changes as an expansion unfolds. Early on, consumer-sensitive areas such as retail, autos, travel, and housing may respond first because households are resuming purchases they delayed during the downturn. Later, as confidence improves further, business investment can become more important. That can help industrials, capital goods, and equipment-related companies perform better. The pattern is useful, but it is never exact. Credit conditions, inflation, policy, and the specific cause of the prior recession can all change which sectors lead and for how long. As an expansion matures, the economy can start showing signs of strain even while headline numbers still look good. Labor becomes harder to find, which can push wages higher. Input costs may rise as factories, suppliers, and transport networks operate closer to their limits. When costs rise faster than firms can pass them on, profit margins begin to narrow. At the same time, inflation may climb and valuations may become more stretched as optimism builds. These are useful warning signs, not precise market timing signals, but they often tell investors that the easy middle part of the cycle may be giving way to a more vulnerable late stage. A typical expansion often follows a recognizable sequence. First, spending begins to recover as confidence improves and delayed demand returns. Businesses then increase output and rebuild inventories to meet that demand. Hiring picks up, unemployment falls, and household income improves, which supports more spending in return. After that, firms become more willing to invest in equipment, facilities, and capacity. Eventually, though, constraints begin to emerge, whether in labor, materials, logistics, or policy. That progression from recovery to capacity pressure helps explain why expansions can be strong for long periods, but still become more fragile late in the cycle. The U.S. expansion after the Great Recession is a good example of how long an expansion can last under the right conditions. Growth resumed in 2009, and for years the economy was supported by very low interest rates and generally contained inflation. Over time, the labor market improved dramatically, housing recovered, and consumer spending strengthened. Unemployment fell from crisis-era highs to very low levels by early 2020. This did not mean every year was equally strong, but the cycle endured because policy stayed supportive and inflation pressures remained manageable for much of the period. For investors, it is a reminder that expansions can last far longer than people expect when the usual late cycle pressures build only gradually. One common investing mistake is treating expansion as a simple all-clear signal. GDP growth alone is not enough, because an economy can be expanding while other risks are quietly building in credit, inflation, margins, or valuations. Another mistake is assuming that all expansions follow the same pattern. Some are broad and durable, while others are uneven and fragile from the start. It is also easy to ignore inflation pressure when it builds slowly rather than suddenly. The better approach is to track a range of indicators and remember that growth reduces some risks, but it does not eliminate them. Section 2. Peak. A peak is the turning point where the expansion reaches its highest level of activity and begins to give way to contraction. It is not a long-lasting phase where everything remains strong for an extended period. Instead, it is usually brief and difficult to identify in real time. The economy may still look healthy at the peak because output, hiring, and spending are often near cycle highs. What changes is momentum. Growth stops accelerating, then starts to flatten, and eventually rolls over. For investors, that distinction matters because the economy can look strong right before it becomes more vulnerable. One reason peaks are so hard to identify is that the data near the top can still look impressive. GDP may still be growing, unemployment may still be low, and spending may still be relatively strong. Industrial production can also remain elevated even as underlying momentum fades. In real time, the signals are often mixed rather than obvious. Some indicators soften first, while others keep looking healthy or are later revised. That is why peaks are usually confirmed after the fact, once enough broad data has clearly weakened. Late in an expansion, the economy often becomes vulnerable because strength begins to create strain. Labor markets are tight, so hiring is harder and wage pressures build. Factories may be running near capacity, which makes it more difficult to increase output without delays or bottlenecks. Supply limits mean that stronger demand shows up less in extra production and more in higher prices. At the same time, interest rates often move higher as policymakers try to contain inflation. When an economy has little spare capacity and tighter policy, it has less cushion against shocks than it did earlier in the expansion. By the time the cycle reaches its high point, imbalances that built during the expansion are often easier to see. Businesses may have built inventories too aggressively, expecting demand to stay strong. Asset prices can look stretched relative to earnings, rents, or other fundamentals. Corporate debt may also be elevated, which becomes more dangerous if interest rates have risen. In that environment, even a modest shock can have an outsized effect because the system is already under strain. The peak is often less about one dramatic event and more about a buildup of excess that leaves the economy fragile. The turn into peak often follows a sequence, even though the exact date is hard to know. A long expansion pushes the economy closer to its limits, and inflation pressures begin to rise. Central banks may respond by tightening policy through higher interest rates or less accommodative financial conditions. Leading indicators, such as orders, permits, or sentiment, often soften before the broad headline data does. After that, more visible measures like GDP growth, employment, or production start to flatten or weaken. The sequence is recognizable, but the timing is uncertain enough that investors need patience and confirmation. A plateau and a peak can look similar at first because both involve growth slowing from earlier strength. In a plateau, activity stays high but flat for a while, and the economy does not necessarily move into contraction. A peak, by contrast, is the final high point before a sustained decline. That means one soft month or 1 weak quarter is not enough to prove the peak has arrived. The key issue is whether weakness becomes broader and more persistent. Investors who confuse every pause with a peak can end up reacting too early and missing the later part of the cycle. The Valoria example shows why peaks are so difficult to recognize in real time. By mid-2024, the economy had posted 3 years of GDP growth, unemployment had fallen to 3.2%, and capacity use had reached a very high 91%. Wages were rising strongly, but inflation had also climbed to 4.5%, and the policy rate had been raised from 2.25%, and the policy rate had been raised from 2, Dauber to 3.5%. At the time, those numbers still looked like strength. Only later, after industrial production softened, retail sales weakened, and hiring slowed, did economists date the peak to August 2024. The lesson is that an economy can appear healthy right up to the turning point, with the weakness only becoming obvious in hindsight. There are several mistakes investors should avoid when thinking about peaks. The first is calling every slowdown a peak, because short pauses and soft patches happen even in healthy expansions. The second is relying on GDP alone, instead of checking labor markets, inflation, credit conditions, and other broad indicators. A third mistake is forgetting that data can be revised, sometimes changing how the turning point looks after the fact. It is also important not to confuse a stock market peak with an economic peak, since markets can turn earlier or later than the economy. And finally, even a real economic peak does not automatically mean the next recession will be deep. A practical way to identify a possible peak is to treat it like an evidence-gathering exercise. Start by choosing the period you want to examine, especially after a long expansion. Then track several indicators together, such as GDP, unemployment, industrial production, inflation, and policy rates. Look for the last clear high point before the data turns flatter or begins to decline. After that, check whether other indicators weaken soon after, because broad confirmation matters more than one isolated number. The goal is not to guess perfectly in advance, but to build a reasonable case that the economy has shifted from expansion into a more vulnerable phase. Section 3. Recession. A recession is a meaningful decline in economic activity that is broad enough to affect much of the economy and lasts longer than a brief slowdown. It is more than just slower growth. In a true recession, output falls, spending weakens, and jobs are lost across a range of industries. The decline also tends to persist for months rather than appearing as a short-lived dip. That broad and lasting character is what separates recession from an economy that is merely growing below trend. For investors, the key idea is that recessions reflect contraction across production, income, and demand, not just the disappointing headline number. People often use 2 consecutive negative quarters of real GDP growth as a shortcut for recession, and it can be a helpful rule of thumb. But official recession dating uses a wider set of evidence because GDP alone can be noisy, delayed, and revised. Analysts also look at income, employment, industrial production, and wholesale and retail sales. That broader view matters because recessions are patterns in the economy, not single data points. One indicator may weaken while another still holds up, especially early in the downturn. The more those measures decline together, the stronger the case that a genuine recession is underway. When analysts assess a recession, they often think in terms of depth, diffusion, and duration. Depth means how large the decline is, such as how far GDP, employment, or industrial output fall. Diffusion refers to how broad the weakness becomes across sectors, regions, or types of spending. Duration is simply how long the downturn lasts. Those three dimensions together shape the overall severity of the recession. A downturn can be deep but narrow, or mild but very widespread, and those are not the same experience for households, firms, or investors. Recessions often intensify because they become self-reinforcing. A shock weakens confidence, and households respond by delaying major purchases like cars, appliances, or travel. Businesses then face weaker demand, so they cut output, reduce hours, postpone investment, or lay off workers. As income falls, households spend even less, which puts more pressure on businesses. That creates a feedback loop in which weaker demand leads to weaker employment and income, which then weakens demand again. This is why a recession that starts with one trigger can spread through many parts of the economy. Credit conditions can make a recession much worse. When lenders become cautious, they tighten standards, reduce approvals, or demand better collateral. Businesses may then struggle to finance payroll, inventories, or routine operations, especially smaller firms that depend on bank credit. Households can also find it harder to borrow for homes, cars, or other large purchases. That reduction in available credit weakens spending and investment even further. In other words, the downturn is no longer just about lower confidence or lower demand. It is also being amplified by a financial system that is pulling back. A typical recession usually unfolds through a sequence rather than one isolated event. It often begins with a shock to demand, confidence, credit, or some major part of the economy. Spending then slows across households and businesses, and firms respond by cutting production, hours, and investment. As that weakness spreads, jobs are lost, income falls, and credit conditions often deteriorate as lenders grow more cautious. Those changes feed back into weaker spending, reinforcing the downturn. Investors should think of recession as a process that broadens over time, not just the moment the first weak data point appears. Recessions can look very different from one another, which is why simple labels are not enough. Some are short and mild, with modest declines and relatively quick recovery. Others are long, deep, and damaging, especially when financial stress or widespread defaults are involved. Speed also matters. A gradual downturn gives households, firms, and policymakers more time to respond, while a sudden collapse can cause closures, unemployment, and long-term damage before support arrives. For investors, comparing recessions by duration, depth, and speed is more useful than assuming every downturn follows the same script. The 2007 to 2009 downturn shows how recession can spread from one sector into the whole economy. The housing bust reduced household wealth and weakened confidence as home prices fell. Financial stress then tightened credit sharply, making it harder for businesses and consumers to borrow. Spending declined, auto sales collapsed, and construction activity fell dramatically. As those forces spread, unemployment rose steeply and real GDP contracted sharply. This episode is a clear reminder that recessions are often transmission mechanisms. Trouble starts somewhere specific, then moves outward through wealth, credit, spending, and jobs. From an investor's perspective, recession analysis works best when it uses timely and broad indicators. It is important not to confuse a market correction with a recession, because stock prices can fall sharply without a full economic contraction. It is also risky to rely only on GDP, which is quarterly and often revised. Payrolls, consumer sales, and industrial production can provide a more immediate picture of weakening demand. At the same time, unemployment often lags, so waiting for it to rise sharply may mean the downturn is already well underway. The most useful approach is to watch several indicators together and look for a consistent pattern. If you were analyzing recession risk for a bank with heavy commercial real estate and construction exposure, you would want very timely signals. Weekly jobless claims matter because rising claims can quickly point to borrower stress and weaker tenant demand. In commercial property, vacancies, rents, and permits help show whether collateral values and future cash flows are coming under pressure. Delinquencies and loan demand are also critical because they reveal whether credit quality is worsening and whether new business is drying up. If those indicators deteriorate together, the bank may need to tighten underwriting, reduce new exposure, or build reserves. The broader lesson is that cycle analysis should always be connected to the actual balance sheet risks an investor or institution faces. Section 4. Recovery. Recovery begins at the trough, the point where the economy stops contracting and starts to grow again. That term matters because it marks the end of recession, but it does not mean the economy is fully healthy. GDP and spending may begin to improve, yet overall activity can still remain below the level reached before the downturn. Businesses may still be cautious, and many households may still feel weak labor conditions. So recovery is best understood as improvement from a low point, not a return to normal. For investors, the challenge is recognizing that the direction has changed even when the level is still depressed. Early recovery can look stronger than it really is because it starts from such a weak base. If output fell sharply during recession, even a modest rebound can produce a large percentage gain. That can create optimistic headlines without meaning that the economy is back to full strength. In practice, activity may still be subdued, credit may still be cautious, and some sectors may remain under pressure. Jobs often recover more slowly than output, which is one reason many people do not feel the recovery right away. This is why investors need to separate rate of change from absolute level. Improvement is real, but the economy may still be far from healthy. Early recovery is often uneven, but several signs tend to appear as conditions stabilize. Firms begin rebuilding inventories after cutting them aggressively during the downturn. Consumer confidence usually stops falling and starts to steady, even if it has not fully recovered. Low interest rates can support borrowing for housing, autos, and business needs. Over time, private demand starts to matter more than emergency policy support alone. These are signs that the economy is moving from pure stabilization toward self-sustaining growth, even if that process is still incomplete. Analysts often look to leading indicators to spot recovery before the headline data fully confirms it. Building permits can improve early if housing activity is beginning to respond. Durable goods orders may rise as businesses and households restart larger purchases. Stock prices also often recover before the economy feels normal because markets are forward-looking. Jobless claims can begin to fall before unemployment itself shows meaningful improvement. The pattern to remember is that recovery usually appears first in indicators that respond quickly to changing expectations, then later in broader and more lagging measures. A recovery can be real and still feel weak to many households. One major reason is that employment usually lags output. Firms often respond to improving demand by increasing hours, using existing capacity more efficiently, or asking current workers to do more before they commit to hiring new staff. That means production can rise while unemployment remains high for a while. In some recoveries, this creates what people call a jobless recovery. For investors, it is an important reminder that improving GDP does not automatically mean a broad return to labor market health. Recovery gains traction when several forces begin working together. First, the downturn reaches a floor and conditions stop getting worse. Then, policy support, such as lower rates or fiscal measures, begins to have its delayed effect on borrowing, spending, and confidence. Businesses often restock inventories, which lifts production even before final demand is fully strong. As the process continues, growth spreads from a few early areas into more sectors of the economy. That broadening is important because it marks the shift from a fragile rebound to something closer to a genuine expansion. When reading recovery data, a small improvement across several indicators can be more meaningful than one strong headline. GDP turning positive after recession is useful, but on its own it is not enough. It helps more if capacity use is rising from low levels. Auto sales are rebounding after a long decline, and other spending categories are beginning to stabilize as well. At the same time, unemployment may still remain high because labor markets often lag. That combination is very typical of early recovery. Broad signs of stabilization alongside continued weakness in jobs. Investors should focus on the pattern across indicators, rather than demanding that every series improve at once. Financial markets often respond to recovery before the broader economy feels normal again. Bond yields may start rising as investors anticipate stronger growth and less need for extreme policy support. Money often shifts toward risk assets, including equities and lower quality credit. Within stocks, cyclical sectors usually benefit because they are more sensitive to improving demand. Smaller companies may also outperform if investors believe domestic growth is picking up. The key point is that markets tend to discount future conditions, so they can move well before the average household experiences a clear improvement. Even in recovery, caution still matters because early rebounds can fail. One positive quarter or one strong data release may turn out to be temporary rather than durable. Jobs may recover slowly, and structural damage from the recession, such as weak lending, business closures, or permanent labor market losses, can linger. Policy support helps, but it may not be large enough or well-timed enough to secure the upturn on its own. That is why analysts look for confirmation across many indicators instead of assuming the first bounce will continue. Recovery is hopeful, but it is also one of the more fragile parts of the cycle. The core investing lesson from recovery is to recognize the turn without exaggerating it. Recovery is the first move out of recession, not the same thing as a fully established expansion. Leading indicators often provide the earliest clues, while lagging data such as employment may still look discouraging for some time. Because of that mismatch, investors can easily become either too optimistic too soon or too skeptical for too long. The better approach is to watch for confirmation across multiple indicators and for improvement that persists rather than fading quickly. In other words, spot the turn early if you can, but trust it more only after the evidence broadens. Section 5. Sector performance by cycle. Sectors move differently across the business cycle because not all industries depend on the economy in the same way. Cyclical sectors are more sensitive to growth, confidence, credit conditions, and discretionary spending. Defensive sectors, by contrast, are tied to goods and services people keep buying even when conditions weaken. As the economy moves from expansion to slowdown to recession and then recovery, household and business spending patterns change. Those shifts create changes in sector leadership. For investors, the basic idea is simple. Different parts of the market respond to different economic environments, so the cycle can influence relative performance even when the overall market direction is uncertain. In expansion, sectors tied to optional spending and business investment often have the wind at their back. Households feel more confident, so they are more willing to spend on travel, entertainment, restaurants, cars, and other non-essential purchases. Businesses also become more willing to invest in equipment, software, projects, and expansion plans. That tends to support consumer discretionary companies, technology firms, and industrials. These sectors are not guaranteed winners, but they often benefit when confidence and demand are both improving. The common thread is that they do better when people and firms are choosing to spend beyond the bare essentials. During recession, leadership often shifts towards sectors tied to necessities rather than optional spending. Households delay large purchases and businesses cut costs or postpone expansion plans. That usually hurts cyclical demand first. Utilities, healthcare, and consumer staples often hold up better because demand for electricity, medicine, food, and household basics is steadier. This does not mean defensive sectors always rise in downturns. More often, it means they may fall less than the more economically sensitive parts of the market. For investors, that distinction matters because holding up better in a weak economy can still be valuable even without strong absolute returns. A common cycle map links broad economic phases with broad sector tendencies. In expansion, investors often look first to discretionary, technology, and industrials. Near the peak, energy and materials may benefit if inflation and commodity demand are strong, and sometimes financials do well depending on rates and credit conditions. In recession, attention often shifts to utilities, healthcare, and staples because they are more defensive. In recovery, financials, technology, and real estate can benefit as credit conditions improve and growth expectations rise. This map is useful as a starting point, but it is a guide rather than a rigid rule, because valuation, policy, and the cause of the cycle always matter too. Sector rotation is the practical application of this idea. An investor first forms a view about where the economy is in the cycle. then checks that view against several indicators rather than one data release. If the evidence suggests a changing phase, the investor may shift exposure towards sectors that are more likely to benefit. That could mean adding cyclicals in recovery, favoring defensives in recession risk, or becoming more selective late in expansion. The process also requires review as new data arrives, because cycle calls are never certain. In practice, good sector rotation is less about bold predictions and more about adjusting probabilities as evidence changes. Because cycle views can be early or wrong, sector changes should usually be made gradually. An all-at-once move creates a large timing risk if the expected phase shift takes longer than planned or never arrives. A more disciplined approach is to trim likely laggards, add likely leaders in measured steps, and keep diversification across sectors. Rebalancing and position limits help prevent one macro view from dominating the whole portfolio. This matters because even a correct cycle thesis can lose money if it is expressed too aggressively. In investing, being directionally right is useful, but position sizing often determines whether that view helps or hurts overall results. Consider a simple recovery example. Suppose the economy appears to be emerging from recession. Manufacturing orders are rising, rates are low, and growth expectations are improving. An investor shifts 10% of the portfolio from consumer staples into financials, expecting credit conditions and economic activity to recover. Over the next 6 months, financials return 15%, while staples return 2%. The difference is 13 percentage points, and applied to a 10% portfolio slice, that adds about 1.3% to the full portfolio. The example is simple, but it shows how even a modest allocation shift can matter if the cycle view is broadly correct. Sector rotation can also go wrong in very ordinary ways. The economy may not recover as quickly as expected, and cyclical sectors can continue lagging while defensive sectors regain relative strength. An investor may have the right long-term idea but the wrong timing, which is often enough to hurt returns. Historical patterns are helpful, but they are not guarantees because every cycle has different causes, policies, and market starting points. This is why sector rotation depends on both the economic view and the timing being at least roughly right. It is a useful tool, but it should be used with humility. Several mistakes show up repeatedly in cycle-based sector investing. One is assuming every cycle follows the same path, even though some recessions are driven by housing, others by tech, finance, energy, or policy shocks. Another is ignoring global influences or policy changes that can overpower the usual sector script. Investors also often rotate too late, after markets have already priced in the economic turn. And even if a sector fits the cycle story, it can still disappoint if valuations are too high or the portfolio becomes too concentrated. A better approach is to treat cycle relationships as probabilities, check valuation, and stay diversified. This quick check shows how to connect sector performance to a cycle view. In the recession data, utilities gained 4% and healthcare gained 2%, while technology fell 8% and consumer discretionary fell 12%. That pattern is consistent with defensive behavior because essentials held up better than cyclical or growth-sensitive areas. If an investor believes recovery is beginning, technology and consumer discretionary might become candidates for an overweight because they often respond more strongly when demand improves. But that view carries risk. If recession lasts longer than expected, those cyclical sectors may continue to lag while the defensives keep holding up better.